Well, we're getting some fresh comments from New York Fed President John Williams. Steve Leisman has the details. Hi, Steve.
Hey, Mike, yeah, he's talking about the conflict in the Middle East, saying he sees substantial risk and high uncertainty in the economic outlook from especially those events. He says the Middle East conflict could result in a large supply shock, and you guys were just talking about this, raising inflation on the one hand and dampening economic activity on the other, putting the Fed in particularly a difficult position. He has said he's already seeing supply chain disruptions in energy and energy-related goods. Tariffs and high energy prices should raise headline inflation in the short term. But he's a little more optimistic, says the effects of both the energy price increases and tariffs should reverse. And that, of course, assumes that prices come down and hostilities end. It's a big part of his forecast that all this happens after hostilities cease. No sign on the good side on inflation, no sign that tariff increases are spilling over to the rest of the economy, and also adds that the labor market is not adding to inflationary pressures that are out there. Overall, he sees a resilient economy, GDP close to 2.5% this year, tailwinds from fiscal policy, favorable financial conditions, along with AI investment. He expects unemployment to edge down and inflation at 2.75% this year, but going down to 2% in 2027. Sees mixed signals when it comes to employment, with inflation stable, but concern about job market expectations. We'll leave it there, guys. I just point out that if you're going to ask me what he said about monetary policy, I don't have anything for you on that. He did not give much of an outlook other than repeating what was in the statement. So sorry to dash your expectations there.
Then it's useless. No, seriously, it sounds like he thinks it's a shock that you should look through.
Yeah, no. I mean, look, what I keep hearing from Fed officials is this idea of kind of scenario analysis, which may be a fancy way of saying we don't really know what to think, but another way of saying we're looking at different options. And most of this particular option or outlook that Williams gave us was this idea that he expects the energy price to work through the system and not to have a long-run effect if and when hostilities cease. Kind of a similar idea from Powell today, where he talked about this idea that energy price shocks tend to be short-lived. That's been the history of these things, and he doesn't want to make policy based on the idea that policy takes a long time to hit the economy, but the energy price shocks can be short, so you may end up adjusting something that doesn't ultimately need adjusting.
Well, at the risk of asking you something else that he didn't address, Steve, because I think it would be newsworthy if he didn't, since he's the New York Fed president and he's the cop on the beat in terms of financial stability, I assume he doesn't necessarily see or didn't mention anything he sees happening in markets that are cause for alarm on that front?
No, and this was not really a speech where he might address that. I think that Powell addressed it. I'm just going to look at my notes here for a second. I believe he talked about the idea that he's not seeing systemic risk in private credit at the moment, right, but they are watching out for that. So I think that's the best I can do with Fed commentary on the critical private credit issue, with a lot of questions, Mike, and I'm listening to your reporting on this as well, which is the extent to which it leads back to the banking system. Through different ways, letters of credit, other methods that are worth watching. But at the moment, Fed officials are saying they do not see it leading back to the banking system or systemic risk. But of course, that was something they said in '07 as well.